option traders, it's time to pony up and let's talk about the short straddle and the short strangle options trading strategy. So in this video, I'm going to go over the setup and also why would someone want to trade this type of strategy. So at Option Scout, I'm going to be reorganizing a few things a little bit, but let's go down to short straddle, okay? So these are going to be the two things we're going to go over, short straddle and short strangle. They're similar. They're very, very similar, but here is the setup. So for a short straddle, the setup is the following. You're going to sell one call contract and also sell one put contract, both roughly at the money. They don't have to be exactly, but you know, there's that, and they're at the same strike price. All right. Now the difference between a short straddle, the short strangle has a setup of the same, so you're selling a call and selling a put, but they're at different strike prices. So you can see here with the short straddle that you know, you're looking at, it has like a little bit of TP, you know, a little bit TP here, and then the TP, the max profit, is at roughly where you choose the strike price. And you can see a short straddle, it's a little different. It goes up and side and then down. So it's because it gets stretched out a little bit. So here's why someone would trade a straddle. So first off, let's get into this. And the reason why someone's going to want to do a straddle is because they believe the stock is going to be not moving too much. It's going to be in a certain range, and you know, usually in most cases a low volatile environment. So yeah, we can do Apple, you know, no big deal. So do Apple real quick, and let's just do a straddle. All right, let's see what it is, and then we'll change it, and we can change it. You can use the straddle calculator to then change to the strangle, but you can do either or, which you want. So let's do this. You're going to sell 138 and sell again a 138 as well for calls and puts. Now, this is definitely an advanced strategy because here's what I don't like to use the word advanced. It's definitely a strategy you should proceed with caution. And usually, in most cases, a lot of traders who do a straddle or strangle, they're not actually having this contract see out. Like, they're not letting it expire worthless, and they're not going to trade this. You know, they're not going to go trade this, go to the gym and come back. They're going to trade this and be like laser focused on their computer, like, okay, what's going on, what's going on, what's going on, what's going on, and then they're going to close it out. So they're hoping that kind of it's like sell high volatility, buy back lower is kind of the process here. Because you can see here that if we stretch out this chart, you go all the way here, you know, that's your little bit of profit, and this is all of your loss you can potentially hit. So that's a lot. Now that's a 68% range, so we're saying, you know, that's a pretty big dip. But, you know, this is a little bit of a scary strategy to do, especially on a stock where, you know, it's moves a lot. You know, if you have a stock that like moves up and down, like, you know, a lot of crypto companies can go up or down 8% in a day. Like, that's a little bit sketch. So now what we can do, we can go back to Option Scout. You know, we can close out this options chain, and let's just go to the strangle. So a strangle, it's going to be the same. It's a very similar thing, okay? So where's our strangle at? Short strangle. Where's my short strangle? Okay, short strangle is going to be down here. Same thing, same concept, but all what you're doing is you're just simply stretching out the strike prices. Now, this is where you'll be making, I guess, less max profit, but you have a better kind of profit range, right? So your profit range, your max profit is going to be the separation of your strikes. So let's say we go out of the money here, which, you know, usually you would go out of the money. It'd be kind of weird to go in the money, but, you know, you can do what you want. It's not financial advice. So let's say we go 146, and then we go let's try to, usually you want to stay at the same difference. So right now Apple's like at what, 138. So let's go $5 out, so that'd be 143, and let's go $5 down, which would be 133. You don't have to do that, but yeah, it should create this little TP type of situation here. We can stretch it out. So you still have the same situation where you have a lot of max loss. Now, your max loss, technically, you're unlimited on the upside, right? But, you know, your max loss on the downside is similar to cash secure put. So what you're really doing here is you're selling a cash secure put, and you're also selling a naked call. So you want to hope, then you can see here, this is the strike price, this is the strike price. So that's your max potential. And your break-evens, you're going to have two break-evens. You're going to have, practically the break-even is going to be this strike minus the credit you're receiving. So you can see you're getting 219 in credit. So you take that strike, you subtract that, and that's your break-even. And then the same on the upside. You're going to take the strike, which is 143, and you're going to add it because that's how it works for calls. So yeah, that's really about the setup. And again, this is a strategy that usually people, it's like sell the high volatility and then buy back lower. So a long strangle would be the inverse, right, where you're thinking of buying it and selling it. I'm going to do a lesson on the setup for that. But if you like that, make sure to subscribe. I'll see you in the next lesson. Liking this video and commenting down anything, questions you have, I would appreciate it. I review every comment, don't always respond to every single one of them. And also feel free to check out optionscout.com where you can visualize your trades as well. So I'll see you in the next lesson.